The Relative Volatility Index stands apart from other technical indicators in several important ways. While most indicators like RSI and MACD focus on price momentum and trend strength, RVI specifically measures volatility direction. Let's visualize how these indicators behave differently on a price chart. The fundamental difference is in what these indicators measure. RSI compares the magnitude of recent gains to recent losses, focusing on price changes. RVI, however, compares the standard deviation of up closes versus down closes, making it more sensitive to volatility patterns rather than just price movements. This unique focus on volatility makes RVI particularly valuable during choppy or transitional markets, where price-based indicators might give false signals. Because of these differences, RVI works best when used alongside traditional indicators, providing a more complete picture of market conditions and potential trend changes. The Relative Volatility Index calculation involves a methodical process that measures the relationship between upward and downward price volatility. Step 1 involves calculating standard deviations of up and down price movements over a specific period, typically 10 days. We calculate the standard deviation separately for up closes and down closes. This measures the volatility in both upward and downward price movements. Step 2 involves applying a smoothing factor, typically over 14 periods, to both the up and down standard deviations. The final RVI formula combines the smoothed standard deviations. RVI equals the smoothed up standard deviation divided by the sum of both smooth standard deviations multiplied by 100. The RVI formula produces a value between 0 and 100, similar to the relative strength index. This scale indicates the relationship between upward and downward volatility. This calculation emphasizes the relationship between upward and downward volatility, providing insights into potential trend direction. Unlike the RSI, which focuses on price changes, the RVI focuses on volatility patterns. For maximum effectiveness, traders typically combine the Relative Volatility Index with other complementary technical indicators. These indicators generally fall into three main categories: price oscillators, trend indicators, and volume indicators. Let's examine how these indicators work together. Here we can see a price chart alongside RVI, RSI, and a moving average. The RVI line shows volatility-based momentum, while the RSI confirms price momentum. The moving average provides trend context. When these indicators align, they create much stronger signals. For example, here we see an RVI bullish signal combined with an RSI oversold condition near a key support level. This multi-indicator approach offers several key advantages for traders. First, it effectively filters out false signals that might occur with any single indicator. Second, it significantly improves overall trading accuracy by requiring confirmation from multiple sources. And finally, it provides necessary context for volatility signals, helping traders understand the broader market environment. Remember, an RVI signal confirmed by other technical indicators creates a much stronger trading opportunity than any single indicator alone. RVI settings can be optimized for different trading styles and timeframes. The standard RVI uses a 10-period calculation for standard deviation and a 14-period smoothing factor. These parameters can be adjusted based on your trading style. Different settings create different trade-offs. Let's visually compare different parameter settings. Shorter periods like 5 and 10 create a more responsive indicator that's suitable for short-term trading, but generate more false signals. Longer periods like 14 and 21 produce a smoother line that's better for identifying major trends, but may be slower to signal changes. When optimizing RVI parameters, you're balancing a fundamental trade-off between responsiveness and reliability. More responsive settings provide faster signals and more trading opportunities, but with higher false signal risk. More reliable settings give confirmed signals but may miss opportunities. To find your optimal settings, you should backtest different parameter combinations on your specific markets and timeframes. Remember that optimal settings vary by market and trading style. Here are some recommended starting points to begin your testing. By finding the right balance between responsiveness and reliability, you can optimize the RVI indicator for your specific trading needs. Let's examine real-world examples where the Relative Volatility Index successfully predicted major market moves. During the 2020 market crash, the RVI showed bearish divergence weeks before the major sell-off began. While prices were still making new highs in February, the RVI was already declining. Similarly, the subsequent market recovery was preceded by bullish RVI divergence near market bottoms. In cryptocurrency markets, we observe the same patterns. RVI divergences have often preceded major trend changes in Bitcoin and other digital assets. These real-world examples demonstrate how RVI can provide early warnings of trend changes across different market types. The indicator's focus on volatility rather than price makes it particularly effective during periods of market transition. While the Relative Volatility Index is a valuable tool, it has important limitations that traders must understand. RVI can generate false signals during strong trending markets, as the indicator may suggest reversals that don't materialize. In choppy market conditions, RVI becomes particularly unreliable, often producing conflicting signals. Like many oscillators, RVI has several key limitations that traders need to be aware of. It's not recommended to use RVI as a standalone tool, and it can lag in detecting major market shifts, especially when volatility changes gradually. To address these limitations, here are some best practices for using the Relative Volatility Index effectively. First, always confirm RVI signals with price action or other technical indicators to reduce false signals. Use RVI in conjunction with support and resistance levels, which can provide important context for potential reversals. The RVI indicator works best when confirmation occurs at these key levels, as shown by these green signal points. Be especially cautious of RVI signals during periods of low market volatility, which can produce misleading readings. Always consider the broader market context and fundamental factors alongside your technical analysis. Most importantly, implement proper risk management regardless of how confident you are in an RVI signal. To summarize the key recommendations for using RVI effectively, no indicator is perfect, so always use multiple confirmation tools alongside RVI. Adjust your RVI settings based on the specific market and time frame you're trading. Test your RVI strategies thoroughly in different market conditions before implementing them with real capital. And remember, regardless of how strong an RVI signal appears to be, proper risk management remains essential for long-term trading success.